I will be presenting about credit default swaps. Credit default swaps (CDS) allows investors to offset the risk of defaults using an investment or premium from another party. Under the agreement, the seller agrees to compensate the buyer if a credit risk occurs. In other words, it is more or less the same as the seller insuring the buyer against asset defaulting in the future. It is worth noting that CDS differs from the interest rate swaps in that latter is based on the underlying assets, while the former is based on the credit risks that are likely to occur. Another difference is that the interest rate swaps often act as hedges or protection against the risk associated with interests, whereas the CDS protects an investor from possible credit risk. Since CDS provides investors with some form of insurance or protection against losses from default, they have become increasingly popular in the US markets. It is however worth noting that the CDS was initially developed to facilitate the transfer of credit exposure within banking institutions. They have since transformed into investment portfolio assets which operate in almost a similar manner as bonds. When it comes to the market overview, CDS used to be expected, especially after 2007-2008-9 financial crisis. However, following the increased regulations that were put in place in 2010, the sales of credit default swaps have significantly declined. Besides, changes in the market environment have also led to significant changes in trade over the last 10 years or so. According to the World Government Bonds, as of May 3rd, 2023, the United States 5-year CDS value is 65.53. This value reveals a 1.06% implied probability of default on a 40% recovery rate supposed. The chart shows the trend of CDS markets in the USA, as we can see here, and the chart shows that the markets declined slightly in 2021 but have recovered more than 40%. CDS market size saw a rapid growth surge following the great financial crisis of 2007 to 2009 due to its role in the crisis, which strengthened transparency and resilience in the financial markets. Credit default swaps played a significant role in the Great Recession event. American banks, including the Bear Stearns, American Group, and Lehman Brothers, issued credit default swaps to investors to protect them against losses in case the mortgages that were duly securitized in mortgage-backed securities defaulted. Since the CDS provided protection against mortgage defaults, investors believed that the risk of the loss was reduced in the case the worst were to happen. CDS was also vital during the European sovereign debt crisis. For instance, to help Greece raise money during a sovereign debt crisis, investors purchased sovereign bonds and CDS to protect their capital should the country default. Since the financial crisis, CDS has undergone several significant changes. While the CDS market was initially formed to provide banks with the means to transfer credit exposure to protect capital, today CDS has become the engine that drives the credit derivatives market. And it's also notable that the market participants have significantly reduced the credit risk exposure and eliminated redundant contracts. And several significant drivers have led to the expansion of the CDS market. Firstly, the increasing demand for cash alternatives and availability of low-cost and affordable credit swap facilities. Secondly, the increase in offshore investments and developments in forex trade has fueled the growth of credit default swap markets. Thirdly, the flexibility of the CDS as an active portfolio management tool has led to the growth of the CDS market. Lastly, the development in the e-commerce industry will provide also lucrative opportunities for the CDS market shortly. Moving over to the CDS product. So credit default swaps protect the buyer against specific risks, similar to insurance contracts. CDS can protect against risks by transferring a given risk from one party to another without transferring the underlying credit asset. Before the inception of credit default swaps, there was no existing vehicle for transferring the risk of default or other credit events from one investor to another. CDS covers many risks, including bankruptcies, defaults, credit rating downgrades, and even other credit risk events. So how does it work? So as CDS has two parties, the buyer and the seller, essentially one party sells the risk and the other buyer buys the risk. The seller who owns the underlying credit asset pays a periodic fee to the buyer, and then the risk buyer in return agrees to pay a specific amount to the seller if there was a default or a credit event. Now the protection seller figure here on the slide shows the CDS between the seller, who is the protection buyer, and the risk buyer, who is the protection seller. I also want to note that the figure here shows the applicable regulations in the credit default swaps to ensure buyer and seller protection during the transaction. Moving over to the accounting for CDS swaps and looking at the profit and loss. So the IFRS 9 and the GAAP accounting standards guide how entities should account for credit default swaps. IFRS is used in more than 110 countries around the world, including the EU and many Asian and South American countries as well. However, the GAAP, on the other hand, is only used in the United States. So the IFRS 9 provides entities with three categories for reporting their financial assets: amortized cost, fair value for the profit and loss, and fair value through other comprehensive income. So the credit default swaps must be accounted for under the fair value through profit or loss criteria. These swaps must be recorded at fair value and no transaction cost must be treated as an expense. However, hedge accounting may be applied by designating the CDS as a hedging instrument. Differences in the fair value become part of the income statement. In the case of a gain in the transaction, the credit swap account is debited and the income account is credited. The reverse applies in the case of a loss in a transaction. That is, as per the GAAP accounting guidelines, which are more or less similar to the IFRS principles. Depending on whether the company is the seller or the buyer, the CDS appears in the statement of financial position as either an asset or liability. So the use of credit default swaps. CDS are most popular credit derivative instrument because they allow investors to trade pure credit risk. They are beneficial because they can be used for hedging, speculation, and arbitrage. In hedging risk, investors buy credit default swaps to provide an additional layer of insurance to protect the bond or credit asset, such as mortgage-backed securities, from defaulting on its payments. A third party, in turn, assumes the risk in exchange for a premium. In addition to hedging and speculation, CDS offers other benefits, including access to credit risk with limited interest rate risk, access to maturity exposure, lacking in the cash market, and more liquidity than investing in the underlying cash bonds. Now, as for the ISDA, ISDA is an association of major market participants. ISDA provides a standardized agreement on CDS regarding terms, credit events, and details of CDS transactions. Credit events range from a company defaulting on its debt payments to a sovereign default. When it comes to the credit events, in this context, often involve failure to pay debts, such as when a company or borrower becomes bankrupt and can no longer honor the debt obligation. Another credit risk event would be when the grace period elapses and, for one reason or another, the buyer cannot pay the principal or interest on time. In such situations, restriction might be an option, but that can sometimes negatively impact the lender. For this reason, investors need some form of protection or insurance to ensure that they face low credit risk if the borrower cannot make the payments owing. Moving over to the risks associated with the credit risk default swap. Credit default swaps pose several risks to financial markets and institutions. Many of these risks are not unique and include operational risks, concentration, counterparty credits, and jump to default risks. There are also concerns that in some cases, the transaction in CDS might lack proper accountability. It is because some disclosures might be omitted when forming the agreement between the buyer and the seller. As such, the lack of transparency and accountability tends to create some form of uncertainty regarding this type of investment. Other securities and investments also contain similar risks, but there are established regulatory frameworks, which is not necessarily true in CDS. In addition, CDS trading is risky because the CDS premium is set such that the value of the derivative is zero at the origination date. Just like other securities, the value of CDS changes due to market situations that affect the risk associated with the asset in question. However, in most cases, CDS targets protecting financiers from default risk. Looking over at the positive and negatives of CDS, let's start with the positives. There are two main benefits associated with the use of CDS. These are the hedging risk and speculation. To hedge themselves against possible default risks, investors purchase them as an added protection on the bond. The idea is to ensure some form of backing or security in the event of a default. They also serve as a speculation tools, which can help access the credit quality of the reference company. That helps the company selling the default swaps to create a system for protecting themselves through diversification. In a way, CDS also helps to ensure that financiers can take on more significant risk as they have some form of protection. That helps pave the way for more businesses and innovations. Um, I forgot to mention the negatives. While there are, of course, the benefits of the CDS as a hedge against credit default risk, it's also crucial to realize its downsides. The main limitation is that sometimes using the derivatives can result in a false sense of security. That can lead to an investor believing that they face no risks, which is inaccurate. Investors should note that investing in CDS does not eliminate all the risks but reduces them. However, they are traded on over-the-counter markets, which makes them prone to additional risks. Besides, the investor of a CDS tends to inherit or take over the risk of the borrower in the event of a default. Finally, some recent notable market news and events linked to the product. Of course, as mentioned, it was in regards to 2008 global financial crisis, where the widespread of use of CDS played a significant role in exacerbating the crisis. Many investors who had purchased CDS to protect themselves against the risk of default or mortgage-backed securities suffered significant losses as the market for those securities collapsed. Also, regulators have recently focused on a trade involving Deutsche Bank, which was on March 24, Friday this year. And according to the source, the trade was roughly 5 million euro bet on swaps linked to the bank's junior debt, and regulators have spoken to market participants about the transactions. These contracts are known to be liquid, so even a single bet can trigger significant market moves. And also, Deutsche Bank has declined to comment. So, thank you for the presentation. And in conclusion, the following points can be made. Credit default swaps are financial derivative instruments for which an entity can hedge its credit risk. Thank you.